Hi. How you doing, Nelson?
Good, Willows. How about you?
I'm doing great. Well, this is the first time that we were able to talk um, in real life, I guess, or as close to as real life as possible. We've had many a Twitter exchange, but this is the first time we've heard each other's voices in real life. So that is nice. And yeah, I was just like, you are one of the people that I've talked to most about this topic that we're talking about, which is A&W specifically, because this is a stock that I am very passionate about. And they've gone through some big changes recently. So I think just quick, if we kind of, and I think we'll come out at this as usual, as I know very little, and I just kind of, I just sometimes I just be saying stuff and it's not true, and I just everything I tweet is financial advice, and I'm drunk half the time, and it's fine. And you are the expert, the professional with a newsletter.
Well, that's high praise. I'll do my best.
No, but I do really like your Twitter content. I think that you do some good analysis of stocks, and I've said this before in your replies that like you break it down in a really easy way where like my like lizard brain where I'm like I can't read more than 6 lines. Like I don't want to read 17 pages of DD and charts. It's like, okay, give me a couple numbers. These make sense to me. All right, this makes sense. This is a good buy.
There's so many people in real life who I know who aren't very interested in finance, and I'm kind of like their guy because it's like they know that I'm interested in it and they know that I've done all the work and everything. And they all tell me the same thing. It's like, just make this simple so I can understand it. And I really try to do that when I tweet about stuff where it's like, hey, like I only have 280 characters. I'm just going to really try to get to the meat of the problem or the meat of whatever I'm looking to analyze, make it very succinct and in an easy way for people to understand. That's what I'm looking to do. And I think that in general, the finance world is filled with too much jargon and other stuff that's designed to intimidate regular people. And when you do that, regular people get scared and they don't invest, and that's very bad.
Yes, I agree with you. They say what they like write everything at a fifth grade level, right? Is what they usually say to people. Because then the general public will understand.
That's what I try to do is make it as simple as possible while still kind of keeping all of the important information in. And the common criticism I get is, what about this? What about this? What about this? And my view is that once you kind of learn how the markets work, is that I always say the stuff on page 103 of the annual report doesn't matter because it doesn't. People get a narrative of a stock or a company and they go with that. And when the narrative changes, then their mind changes. And the accounting details, most of them don't matter.
Yeah, yeah. I think that's a fair assessment. Um, so as far as A&W, which we're talking about today, let's just briefly kind of go over. I understand. I think I'm most of it, but let's briefly go over the royalty kind of setup that they were previously, and now, if I understand correctly, they are not going to be like that anymore.
Correct. So the way it is right now and the way it was previously is that A&W is a royalty company. What does that mean? It means that the A&W that traded on the stock exchange owns the A&W trademarks. So that is the logo, that's like the Buddy Burger trademark, Chubby Chicken trademark, Bean Burger trademark. It owns all those trademarks. And what it does is it rents these trademarks back to A&W Food Services, which is the operating company, in exchange for 3% of the sales of the underlying restaurants. So we all know that the typical franchise agreement works where a franchisee agrees to pay a certain amount of sales back to the owner. It's the same kind of thing, except the owner is this publicly traded entity that is separate from the operating company, so A&W Food Services. Now, what this transaction is doing is A&W Food Services is buying A&W Revenue Royalty, the royalty company, to create one company. to get rid of that confusion.
So why would a publicly listed company, decide to do a royalty model rather than operating the actual restaurants?
So the answer is in 2004 or 2005 when A&W was public. I don't remember exactly which year. It was during the income trust boom in Canada. And of course, Willows, you're a little bit young to remember that, but some of the people who are a little bit older might be watching this. Remember that starting in kind of the early 2000s, interest rates went down and investors were very concerned about getting yield. So these entities were created that pass through their tax liability to unit holders, and therefore they could pay these big dividends. So A&W structured it so they could pay the biggest dividend possible as an income trust to hopefully attract investor interest.
And companies, and okay, before we go any farther, we need to make it clear that the A&W in Canada is not the same as the A&W in the United States. The quality is significantly better. I have argued publicly, and I will before, I think A&W is my favorite fast food burger. I think it's the highest quality fast food that we have here available. And in the when I don't even know, in the 90s and the 2000s, the whoever was running it in America bought it out, the trademarks or whatever, and it just basically tastes like Burger King or anything else down there. I remember being very disappointed the first time. I was like, oh, like, we're road tripping, and I'm like, oh, an A&W, and then it's just like, oh my god, this is not what I was expecting. Um, and then yeah, so for reference, like companies like Boston Pizza, and we were talking about the Keg today. Companies like that are also set up similarly with this royalty. The way, yeah, that's how they have it set up. And then a company like restaurants brands that owns like Tim Hortons, Popeyes, Burger King, etc. They're set up like this, where the operating company owns most of the company.
Exactly. The operating company owns everything restaurant brands, McDonald's, Yum, which is of course KFC, Taco Bell, Pizza Hut, Domino's Pizza. Most every other fast food joint is set up like restaurant brands, where one company owns everything, and it's a much simpler kind of model versus a royalty trust. And what's happened over the years is that because the royalty trust structure is different in terms of A&W, Boston Pizza, the Keg, like you mentioned, is there's a lot of investors who look at it and they're like, "This is weird. I'm out." And that's been a problem for these royalty companies.
Okay. Yeah, because like I guess like I see the merits in both, because like I guess like the royalty method, like there's a lot more onus on the franchisees to, it's like you're getting your 3% no matter what, right? If you're the royalty owner, but then also you have like there's no incentive, there's no way that you can hit the boots and to the pavement and go sell more burgers or come up with a whatever. Um, so is there a plan for the A&W? Like, do they own any corporate stores at the moment?
There's a few that they own in terms of a franchisee will lose it, and then A&W will come in and say, "Okay, we're going to run this for a little while until we can refranchise it." But they are 99% franchised,
That's what I
so it's
thought.
essentially a franchise play.
Yeah. So, and do you think they will run more corporate stores under this new?
No, they've come out and said I listened to the conference call that
Mhm.
management explained what was going on, and they said, "Look, we don't want to run stores. We don't even have any big capex requirements, kind of going forward. They spent a bunch of money in the last couple of years on their app, so corporate paid for the app, and then they just let the stores kind of use it as part of the as part of that infrastructure technology spend for the stores. They have no plans to spend anything on any additional infrastructure. Now, A&W did sign a deal fairly recently to bring Pret A Manger into Canada, which is a British kind of coffee and food chain. Think kind of like Tim Hortons, but with better food and no donuts.
Better food than Tim Hortons?
Mm-hmm.
That exists?
It's delicious. I made sure to sample. I was in England about 18 months ago now, and every Pret I went to, I said, "Hey, I got to go here for lunch." The mac and cheese for fast food mac and cheese was fabulous.
Yeah, because I remember reading about that. Like I posted about that merger or whatever they're doing, bringing them into Canada, and it didn't seem like they were bringing a ton of their products in. Like it was just the coffee or something. Like as far as I read.
So it was a pilot project at first. They were bringing in the coffee and a few select kind of items to, excuse me, to try in some of the stores. And the pilot project was successful, and now they have the full rights to bring it into Canada. Now we're a little bit kind of uncertain to what exactly they're going to do. They're sort of cagey about the whole thing because I think they're still figuring it out themselves. The first step is going to be Pret Coffee in A&W restaurants starting in the summer and in the fall. And I think it'll be fully out in 2025, I believe they said. So that's the first step. Other than that, I really don't know. The strategy, all they said in the conference call was that, hey, we're going to get franchisees to kind of pay for this, where it's like, hey, if you want Pret's got these like warming ovens kind of, or just go and you just grab your food, it's ready. Um, Franchisees will pay for those rather than the company paying for those.
Does that help their brand? Like I've never heard of this company until this merger happened.
Um, I mean, I think so. I think that Pret is kind of the same sort of business model as A&W is in terms of like kind of a little higher quality food, so you can get a little bit higher price for it. I think that in that kind of perspective, the two brands work well together. But that's the problem is that you've got this British brand that has kind of sort of moved around the world a little bit. It's got some stores in like continental Europe, for instance, a few in the United States, but it's not that big of a deal outside of Britain. And you've got a bit of a learning curve to kind of say to people like, "Hey, look, we've got this stuff and it's good. You should try it." But at the same time, it is successful in Britain. I think there's something like 800 locations in England. I might be wrong on that, but there's a bunch of them anyway. It's like it's not quite as much as like say a Tim Hortons or Starbucks here, but it's close. There's a bunch of them out there, and at least they know that the brand has been successful in the UK, and they can look at kind of what's been successful there and just kind of start with the best stuff and then kind of move down from there.
Okay, yeah, because like when I was talking about it with my real life friends, everyone was like, I've never heard of this brand before. Like,
Mhm.
so, and I thought that was maybe like when I first heard about it, I'm like, okay, maybe just because I'm not a coffee drinker, I don't pay attention. But then like everyone I talked to was like, what the hell is this? Um, but I guess like more like very likely they knew that the Pret thing was happening at the same time that they knew that this royalty change was happening as well, right? Like I'm certain they've been working on this for a while.
Exactly, exactly. The Pret thing was, I mean, I think it was about a year ago that they started the pilot program, and then a couple of months ago they announced that they had moved forward with kind of this whole big kind of partnership, and there was definitely some uncertainty from investors' perspective. I mean, I remember thinking about it where it's like, okay, how is this going to work in terms of the A&W royalty model? Because the royalty company owns A&W royalties. It did not own Pret royalties. And the company said, look, like any Pret products that are sold in A&W royalty holders will get their cut. They'll get their 3%. But that's all they said. And this announcement really kind of simplifies the whole thing because like now we know that any Pret sales are going to be treated just like A&W sales, and it makes it much more simple. It takes out that uncertainty.
Yeah, because yeah, I think that's a good making things more simple, like you were saying, for the average investor to invest in is a good idea. And I guess like more, if you make it more simple, more investor money rolls in, which gives you more opportunity, et cetera, et cetera. So I'm just reading from your tweet here. I'll put it on the screen if I remember, but you were saying the new company will be 60% insider owned, with the largest shareholders, including management and former management, at about 40%.
Yeah. So the structure right now is there's a private equity firm called Four Vest or something, owns about 20%. And then 40% is owned by current management and former management. And then the public's going to own 40% of the total. So generally people like when there's more insider ownership, the fact that management and former management like the company enough to continue to own it is generally perceived as a positive.
Yeah, I would agree with that. I think it keeps the management motivated. They want to see their company, keeps them loyal. Um, and typically, if I ever see companies that are like they had a bad quarter or whatever, and they're going down, and then all their like C-suite start gobbling up shares at a discounted price. It's like, all right, well, they obviously think they're going to recover, and it's someone who owns multiple businesses myself. Like, I know better than anybody the direction the
Mm-hmm.
business is going. Um, you can make to the public for a long time, you can make it seem like you're doing good when you're not. Um, but the opposite is like if the street thinks you're doing bad, but you're actually doing good. Um, you would know that better than anybody else as the executives that are running the business. Um, so you're saying like so how is this like structurally working? Like the company AW.UN will be gone.
So what's happening is the operating company is buying out the royalty company, and then the operating company will be traded on the TSX. So what it's done is it's taken this complex royalty structure, it's going away, and it's going to be at the same model as restaurant brands, McDonald's, Yum, all of these other fast food companies, which will hopefully create more shareholder value for everyone. But I think the big motivation here is just simplifying everything and just him being able to say to the market, like, look, we're the same as everyone else. We were different. Now we're the same. Treat us the same.
And the times changed from 20 years ago when the royalty maybe made more sense. Do we have any idea? Has this happened historically with companies?
Ooh. I'm trying to think of. There's a TSX company that buys out these royalty streams. They own Mr. Lube. They own, um, I think, Mr. Mike's Steakhouse. There might be a couple more that they own. But in terms of an operating company buying out the royalty company, I can't think of any that have happened before.
So this is almost like we have. We'll see what happens, I guess.
Well, it makes loads of sense, and I know that I've owned A&W shares since 2018. I think I bought the first kind of bit, but I bought most of mine in 2020 when everyone thought the world was going to end and no one was going to buy a hamburger ever again. And what's of course happened is that after from 2020 to 2022, A&W did incredibly well because interest rates were low, and the shares were viewed as kind of a bond proxy. So as interest rates went down, A&W shares went up because investors were happier with a lower yield. So what's happened in the kind of 2 years since is that interest rates have gone up, which means A&W shares have gone down, and the dividend yield is much higher than what it used to be. It was in the kind of 4% range at its lows, and now before the transaction was announced, it was like 6.6, 6.7%. So the shares have languished for a long time, and I think that frustrated both kind of shareholders and the operating company. But I think the big thing for the operating company was looking at it and saying, "Hey, look, we can probably get a pretty good deal if we essentially buy out our own shares," which is what they did.
Yeah, because I got a dividend yield at 6.73% right now, um, which is high.
Mhm.
Um, Let me just check these. Yeah, like and I mean, they cut their dividend right during COVID as well.
Yeah,
Do you
they did. Yeah.
what do you think about that decision?
Well, I think that a lot of companies kind of panicked a little bit in COVID, and they were like, "Hey, we don't know what's going to happen, so let's just cut the dividend and kind of wait until things get back to normal," which I mean, hindsight's
Yeah.
2020, obviously, but a lot of these companies really didn't need to do that. Or in the case of A&W, when I believe they cut it all the way to zero for
I
a few
I
months
think
there,
they did as well. Yeah.
and
Um.
that was probably kind of a overreaction.
Yeah.
And what I've there's a lot of investors who just kind of like as soon as a company cuts a dividend, like that's it, they're out. And I'm not quite that rigid. I look at it and I say, okay, look, if it's 2020 when a lot of companies cut their dividends and a lot of companies panicked, you're kind of forgiven. If it's kind of bad, just you're struggling and you have to cut the dividend because of that, well, then that's a much kind of different decision than in 2020 when everyone panicked.
Yeah. I guess yeah. In retrospect, hindsight 2020, like they were on skip the dishes before COVID. Like I don't understand.
Mm-hmm.
I don't know where the mentality exactly came from. That was like people are just gonna stop eating, like because I haven't jumped into their financials, but I assume their sales went up probably during some of those lockdowns.
Well, their sales were down in 2020, but 2021 was above 2019,
Yeah,
and they've just gone up since. So
yeah,
the slowdown, the big slowdown for A&W, they have so many mall locations, and
mm,
malls were
mm.
kind of closed down in Ontario and stuff for longer than that. So they were getting to skip the dishes business, but they were losing the mall business, and that's what did cause the sales to go down. But they rebounded quickly, and I think they said in the investor presentation for this deal that sales have been up every year from 2002 until 2024, with the exception of 2020.
Yeah. Like we have a lot of gas station A&Ws here. I don't know if that's
Mm-hmm.
common, but we have a lot of those. Um, I know that the one kind of near me is one of the highest selling franchises in the country. And they're open 24/7. It's right off like it's on the Trans Canada basically right through the city, and it's always packed middle of the night. We used to hang out there a bunch, because it was like if you're in the area, that's like the only thing open, at 3 a.m. or whatever. Um, so yeah, I don't know to end that thought. I don't know about cutting the dividend to zero. That seemed short sighted to me. Because even if everything cuts down, also like who's making that decision? Like the royalty company that doesn't actually operate any of the stores.
So it's the same management in the royalty company and the operating company.
Okay.
So they work hand in hand.
Yeah.
And basically they just panicked, and it was just, hey, we got to conserve cash because who knows what's going to happen. And it's a regrettable decision in hindsight, but at the time it was like, I remember how crazy everyone was getting, and it was debatable at the time, but now in hindsight, it's like, yeah, that was a bad decision, and
Yeah.
that's gonna it.
Because like we've talked about before many a time on Twitter about like companies that raise their dividend for no reason. Um,
Mhm.
you know, uh, what is it? What is what are they called? What is that actual company called?
Realty income.
Realty income. Yeah, like just
Mhm.
raising your dividend every single quarter because that's what you do. Eh,
I mean,
like I don't know about that.
that's that's marketing, right? Like
Yeah.
that's all that is. And I point to Canadian Utilities as the example here in Canada, which is owns a bunch of kind of electricity assets in Alberta, Northwest Territories, Yukon. They haven't actually increased their earnings for years, but they keep kind of ratcheting up the dividend by like a penny or two pennies every year because they have this like 50-year dividend growth streak. And just a quick look under the hood, and it's like, okay, you guys are just increasing the dividend because you value this marketing piece of we've increased the dividend for 50 or 51 consecutive years or whatever it is. The bottom line is not increasing, and that's a problem if
Yeah.
you have a dividend increase without the bottom line increasing. Now, realty income, I don't know it that well, but my understanding is that they are increasing their kind of their bottom line. But I kind of agree with you, where it's like, if you're just raising the dividend every quarter for the sake of raising the dividend every quarter, like
Well, and where does it end?
there's
You
really
eventually run out of expansion, right? Like the fault of capitalism is that it's like a basis, a belief based on infinite growth in a finite system, right? Like eventually you run out of office buildings to buy.
mhm.
So what do we
Yeah,
do
exactly.
then? Now we're reevaluating. Like, um, I did a whole thread about. I went to the AGM of Exchange Income Corp here in Winnipeg,
Mhm.
and they had a good line. Like the CEO was talking, and he's like, "Yeah, we don't just raise the dividend to raise the dividend. We raise the dividend when it makes sense to raise the dividend, and that's when they add." Another company, they save up some cash for those years to make the acquisition, and then once that company starts bringing in more revenue, then they raise the dividend. And
Mhm.
they kind of like, yeah, because just raising it to raise it, then it's like now COVID's happening. We still have to raise it, otherwise we break our streak. And you know, but
Exactly.
also like the the joke that the market is filled with rational investors, right? Like a lot of rational investors see a dividend cut that may be warranted because it's like, oh, we're focusing on expansion, and then they're like, oh, up the stock, they're failing, they're going to go out of business.
Yeah, I mean, it's like, you've seen the kind of dividends versus total return debates on Twitter and all these things that I don't really get involved in because they're just stupid. But
Yeah.
like it for me, it helps to really kind of zoom out, be like, okay, what's the point of a dividend? Well, a dividend is a share of the profits in the company. And if the profits have fallen or the profits have stayed flat or whatever, and it doesn't make sense to pay out more than 100% of the profits or more than 70% of the profits or whatever kind of the internal target is, then it doesn't make sense to pay out that much of the profits. And then at that point, it's like, okay, well, there's been a dividend cut, then people can say, okay, I'm out. I'm just gonna like, I know people who it's just there's a dividend cut, I'm out,
Yeah.
and I don't hate that strategy because it's consistent and there's logic behind it. Like it's hey, profits are down, therefore the dividend has to be cut, therefore I'm out. I
Yeah.
don't mind that, but when the dividend drives the investing decision, that's a problem. And that's kind of one of the common things you see with some kind of newer beginner dividend investors. The ones who have been around and know what they're doing, they understand that a dividend is just a function of profits and they're looking at the underlying growth and et cetera of the company. That's the important. It's not the dividend, it's the underlying growth.
I was one of those investors not too long ago that was, drawn in by high dividends. Thankfully, I had learned better by the time I got wind of like the yield max stuff with like 170% dividends because they're selling covered calls on Ethereum holdings or whatever these these companies are doing, which is unsustainable, obviously. But I think like right around the 5% mark is pretty sustainable. 5, 6, 7%. I don't think is unsustainable in most of these businesses.
Yeah, it ultimately depends on the underlying earnings. So you can't. I don't like the anything over 5% as a sucker yield that's going to be cut because A&W is which is a 6.7% yield, and yeah, A&W cut the dividend, but it wasn't a like it wasn't because long term profitability was impacted. It was because this big event happened, and they said, "Oh shit." Um, what are we going to do? Let's just cut the dividend and ask questions later.
Yeah.
And so there's nuance in everything. And the other thing is, as a royalty company, A&W had basically no expenses because the operating company was taking care of everything. All A&W royalty company had to do is basically pay to be publicly traded, pay the accountants, and pay the taxes.
Yeah.
And that was it. So what they could do is they could pay out 100% of um, their income, and it was never a problem in terms of the dividend kind of needing to be cut or anything. If sales ever went down, they would have a little bit of a reserve where they could kind of maintain that dividend until sales would go back up again. But A&W has been very good at consistently growing sales, so that was never an issue.
Yeah. Um, so structure wise, just so I understand, previously none of the operation company was publicly traded or anything like that.
Correct. Yeah, it
Okay.
was the royalty company that was publicly traded,
Does that
and now the operational company will be publicly traded.
does that create any like weirdness with like obviously if you're publicly traded you have to report on everything, all your financials and stuff. Does the operational company have to like when they're not public?
So what they did is they disclosed certain information to investors, the operating company, even though they didn't have to, because it gave royalty company
Looks better, right? Like if your
their
sales are going up.
yeah. Well, I mean, they would disclose sales to the royalty company would always disclose sales. That was basically it. And the operating company would disclose a little bit more than that. They disclose like an EBITDA number, earnings before interest, depreciation, and taxes. And they would disclose that. They would disclose a little bit. So they went over and above kind of what they had to do, but not nearly as much as you would expect from like a restaurant brands or McDonald's or anything. So now that the operating company is publicly traded, you'll see a lot more information um, on their part come out.
So this will be the first time that people like investors can actually dive into every single nitty gritty number, um, which I think will be interesting. Are they under any obligation to publish like financials from before this change happens?
So they have published some. If you go to the website, which I think is awinecomefund.com, something like that. Just Google it, you'll find it. They have management presentation that gets into. There's two of them that are out. There's one that kind of really breaks down the detail of the deal. The other one is a lot of information about A&W, the company, and they disclosed some really interesting things that they didn't disclose before in terms of. I mean, there's a bunch of things. The thing that really comes to mind quickly is that they have an agreement with Suncor, the parent of Petro-Canada, to build 90 restaurants on Suncor Petro-Canada sites between now and 2027. So there's about 1,200 A&Ws out there right now.
Oil
So
workers
that's a
love
pretty
A&W.
significant number.
I have learned that in my
It,
experience. Oil workers love A&W.
in every small town in Alberta, every oil town, there's an A&W. There's an A&W and there's a Subway,
Yeah.
and they are all consistently busy
Yeah. Yeah.
until oil craters, and then they're not so busy anymore.
Yeah, that's fair. But then that's, the only place to eat, so it's like
Exactly.
so overall, I guess you're pro this change?
The big kind of advantage to this change is that because A&W was a royalty company, you are limited to the increase in sales in terms of kind of how much your investment would go up. It was just linked to sales. So if the sales were up like 4%, then earnings were up 4%, basically, like across the board. There was a little bit of kind of with tax timing and stuff that would influence that a little bit. But for the most part, it was just 4%, 4%. Like that was it. Or, you had a good year and sales were up 8%, then 8%. You had a bad year, sales would be up 1%, then you'd be up 1%. And it capped the upside is what it did. So now that you get exposure to the whole company, there's other things kind of going on besides the A&W sales. So for instance, all the A&W soda that gets sold in grocery stores and gas stations and whatnot, A&W gets a piece of that. And ultimately what's happened is A&W Food Services has grown earnings faster than the A&W royalty company because it has these other levers that it can kind of pull to kind of increase profits. So it's in the presentation. I believe the sales on the royalty company from kind of 2000 to 2003 were up like 8% a year, and of course the big chunk of that was 2020 to 2021. But they kind of grew sales other than that as well, where EBITDA was up 11 to 12% every year. So you get kind of more exposure to, you get more operating leverage on
Yeah.
owning food services versus owning the royalty company.
Because if they can improve their like profit margin, that might make the investment more attractive to investors. The stock goes up. But previously, if it was a royalty model, we're not even looking at that. We're just looking at gross sales, which
Exactly.
for a
Yeah.
lot of businesses isn't the most relevant metric. It's just how much I can sell $1 billion of burgers too, but if I don't make any money, doesn't matter, right? Do
That's
we
it. Yeah.
do we know how much money they make from that like bottled A&W root beer?
It's hasn't been disclosed yet, but
I guess it will be.
my it I it's hard to say like kind of what kind of detail they'll get into that, but it's probably just a kind of a royalty deal from Coke, whoever I think it's Coca Cola that kind of distributes it and everything for them. So that'll be the. I don't think it's a huge driver, and I know that my background before I kind of started doing the newsletter is I was in grocery,
Yeah.
and I know kind of the soda trends, and soda has just kind of been declining steadily year over year, and things like vitamin water and kind of the better for you beverages have kind of
Should I
been
block the
taking
brand?
taking the place. What do you got there? I can't see it.
Find
Oh,
Pepsi. You get free promotion from me. This is the only Pepsi brand I like over a Coke brand. I drink 7 of these a day.
bubbly is we we had a lot of sales growth with bubbly. We pushed it hard because the one of the dirty little secrets of the grocery business is that nobody makes any money on 12 pack soda or 2 liter soda. Like the only company it does is Pepsi or Coke. The grocery stores all sell it for cost or below cost
Just yeah.
as a like way to get people in. But we could make money on bubbly, so we pushed it hard and sold a bunch of it.
I am a big bubbly fan. Pepsi, send me a shirt. I will rock it. I have tried every other like Coke has AHA. It's not as good. I have tried every other competing brand. They just can't get the flavors as good. The bubbly flavors are so good, and it's the only Pepsi product I like consistently buy. Um, I drink so many of these, and then you can't fucking win. My dentist goes, "Oh, that's gonna destroy your teeth. The enamel is gonna be this is how he talks, worn out from the whatever the carbonation." And it's like, well, okay. So here's the thing: is I was able to cut out like 2 beers a day by just tricking my body, especially the morning beers. Like I just crack the bubbles, and my body's like, "Oh, thank God we're drinking beer." I'm like, "Haha, you idiot." You absolute moron, we're drinking non-alcoholic water. Um yeah, I'm also drinking a beer for the audio listeners. But it is what it is. Um but yeah, no, I know the whole um I swear I'm putting it back on topic. I know the whole like cane sugar thing is just a marketing thing, but like A&W has been doing, in quotations, healthier soda for a long time. They were way ahead on that trend where they were like trying to cut off the high fructose corn syrup and whatnot on the root beers a long time ago.
Yeah,
And
that's been a trend for about the last decade for A&W. Apparently, what they did is they went to millennials and they said, "Okay, what do you guys value?" And the answer was better
yeah,
ingredients. So they did things like, they hormone-free cows that they get their beef from. They chicken is whatever kind of special chicken. The eggs are like free range eggs
yeah.
or whatever, and that was part of it was making the root beer out of cane sugar. So they've kind of tried to position themselves as kind of the fast food joint where it's like, hey, the ingredients are a little better for you. You would try a little bit harder, and it's I don't know how well it succeeded or not, but the fact that we're talking about it shows that they've had a certain amount of success.
Yeah, like I definitely I haven't eaten McDonald's since high school. I used to eat so much. I haven't eaten Burger King since I lived in a trap house. Like, but I take I turned 25 and I'm like, oh god, I'm dying. Tried to take care of my health a little bit more, and I've cut out a lot of fast food, but A&W is something I always go back to. But I feel like the quality of the beef is just like, you can tell when there's a little bit more care. And yeah, look, the last 4 years notwithstanding, it used to not be that much more expensive than anything else. Now I'm paying $10 for a teen burger, but back in the day, it was like, it wasn't that much more, 30% more expensive than McDonald's for a much better experience in my mind. And yeah, I'm scrolling the Wikipedia here, and it's like they're talking about how they were like 10 years earlier than it was legally required. They like started using like pigs that weren't kept in little crates or whatever, and like 5 years before it was legally required, they went to paper straws over plastic straws, like stuff like that, which suck, but that's neither
Oh
here
yeah.
nor there. It feels to me like they were ahead of a lot of trends, as far as that goes, which I think like, in my mind at least, McDonald's has had it kind of had their day in the sun, and they peaked and they're not coming back up. I think A&W is the opposite, where I think they have a lot of growth potential still as a company, because they keep
Yep.
ahead of these trends, and especially as like the older generations die, probably from gastric bypasses and whatnot from eating too much McDonald's. I think like my generation is for sure, and then even the younger ones are, I think, for sure thinking about this a little bit more.
Yeah, the McDonald's growth is emerging markets, is
Yeah.
that part of the world. It's not in North America. It's not in Europe. They're just too established there. So I kind of fully agree with that. In terms of A&W, it comes down to marketing, I think, and their marketing is a little bit more clever than everyone else, or a little bit more kind of ahead of the curve,
Yeah.
like you said.
The what's his name?
And
Who's the okay? If I Google A&W guy, I did get it. Alan Lulu.
Really surprised to find that it's on our value menu.
Harry, you've got to try this.
Now let's take a look at the weather.
Sports.
Sports.
Buddy Burr.
and we all know who that is,
Yeah.
right? Like you say A&W guy, and it's just got a short, balding guy who's kind of goofy.
Yeah.
And we all know who he is, and that's good marketing. If your spokes guy is so recognizable that it's like, that's the A&W guy, and you know it immediately,
Yeah.
then you created, like, that's helped create the brand, right?
He was a extra in Bruce Almighty.
Good for him.
Played Office Staffer 2.
Now I'm gonna have to watch Bruce Almighty and see if I can find him.
And then his IMDb page is literally like, he's been acting since he was 7, but most widely known as quote A&W guy. But that was the first thing that I thought of when you just said A&W marketing. I'm like, oh yeah, those commercials are great, and I haven't had cable in a decade, and I still remember these commercials. And they were doing, when YouTube pre-roll ads were more of a thing now, or more of a thing, I think, when they were first coming out and brands were starting to use them. A&W did the great ones where they were like 5 seconds long. Like, it was like, oh, you don't have to skip this ad because it's done. We're done. Where like the other brands like McDonald's would have a 1.5-minute ad, and it's like, no one's fucking watching this. And like by the time you get to the 5-second skip, they haven't got their point across yet. And I remember thinking,
Exactly.
I remember talking about that when that was happening. I'm like, they're actually ahead of the curve on this one too, because it's like, oh, they're getting their entire message to me in 5 seconds, and then at the end of the 5 seconds, they were like, you can keep watching if you want, but don't worry about it. And it's like, oh, that's giving me brand loyalty. So on top of the quality being better, in my opinion, I think also they've been able to, because like, does McDonald's even use Ronald McDonald anymore?
Well, I think people think Ronald McDonald's is this kind of creepy pedophile clown. So
Because
no,
I know like the Grimace shake
Grimace
thing.
is yeah.
Yeah. That was like, but that was they didn't control that, right? That was just a meme that happened. The
Mhm.
Grimace shake thing, like that was just an organic. They happened
Exactly.
to, you can't say to your shareholders, okay, we're gonna have a viral meme happen. Like, okay, good luck. Um, but like, it's like I can't even think of McDonald's advertising nowadays. Like they got rid of the whole. Do they even
It's
have? Do
very
they have like play places anymore? Or
no, because
COVID?
the well, it was COVID. Plus, I think the franchisees are like, we don't want to clean like
Yeah,
kid puke and
and
stuff.
it's like we can't even get in there. Like, but I remember. Like, do you have kids?
No.
Okay, yeah, neither do I, or that I know of. But like when I remember being a kid, and like that would be some birthday parties, as we'd go to a
Yeah.
McDonald's and play in the tube slide. And like looking back at that, it's like at a fast food place. But I guess like, and I think and that's why I will defend my opinion on this is I think McDonald's has peaked, and I don't think there's any, and I don't want to say they're tricking less educated consumers to continue their expansion, but they might be going to developing countries and tricking less educated consumers for their expansion. But that cannot last forever because the rest of the world is developing too. And I think I talked about this when I was on the Newcomer Invest podcast, where like I really respect a company that can just do what they do well, and
Mhm.
like A&W being just in Canada and like trying to like improve their restaurants here rather than like okay, let's open 100 new restaurants, let's open 1,000, whatever. There's something to be said about that. I think a company that can just
The
focus.
the fact that A&W went up against McDonald's, Burger King, Wendy's, um, other burger kind of fast food joints that I can't think of. They are the number two hamburger QSR, quick service restaurant in Canada. So they went up against giants and they succeeded.
Yeah,
And the fact that they were able to do that speaks volumes. And the fact that they can continue to do that even after getting to 1,100 or 1,200 locations, whatever the exact number is, that's a really kind of bullish indicator from my perspective that they were able to go up against the best and essentially win.
yeah. I got here as of 2022. They were the second largest fast food hamburger chain, only behind McDonald's.
Yeah, I can. That's okay. I can look up the exact amount. I know I have it on my screen, but it's about
Yeah,
1,200.
yeah. I
And
got
um,
1,029 as of 2022.
okay, so that would be maybe closer to 1,100 then. Um, anyway, the point is, like you said, they went up. They're number two to McDonald's, and the fact that they went up against that Goliath is impressive.
Yeah, no, I agree. I think they're, yeah, it's a well run company. Do you think they have aspirations now to expand outside of the country?
I think well, it's tough because you talked about the A&W in the United States. You can't
Right.
expand into the United States because of and it's just too bad because they should really go and buy the United States
The rights
A&W and W
back.
and just turn it around
Yeah.
because they're just so much better operators than the US. But no, I think the long term kind of growth comes from more A&Ws in Canada, but from Pret or other kind of banners or whatever you call them. Restaurant brands has, of course, Tim Hortons, Burger King, Popeyes. They bought Firehouse Subs.
Yeah.
There's kind of that potential to sort of roll up one of many kind of other fast food brands. Maybe that's the kind of the end game. But I think for right now, it's just A&W and Pret, and maybe in 5 to 10 years they do something different.
Can they open a standalone Pret store?
Yep.
Okay, that's interesting. Actually, now that you say that,
In fact, I think they have one in Toronto as like a
like a test.
test
Okay.
store. Yeah. So when you look at Pret, I think there's kind of the low hanging fruit, and then sort of the bigger rollout. And the low hanging fruit is just like I said, putting Pret products, the coffee into A&W stores. That's easy, and you get the franchisees to pay for any kind of equipment that you need. The longer term game, of course, of setting up standalone Pret locations and everything like that, that is a kind of a multi-year, almost like decade-long kind of plan, and it'll take a while for that to get to any sort of critical mass. Because that's the thing with A&W is you look at their growth over the years, and it's just kind of steady, like open, grow the store count 3 to 4% a year, and that's it. It's just incremental. It's not, they don't go nuts. They're not going to open like 200 Prets at once. They're going to be cautious about it, and they're going to roll it out slowly.
So I thought this was interesting. Revenue wise, they're roughly the same size, Pret and A&W Canada.
That is interesting.
Yeah.
I didn't know that.
Revenue I got for A&W around 1.35 billion Canadian, and I got 790 million pounds sterling revenue, which is 1.4. So they're within like 600 million or 600,000. Oh no, there's too many numbers. Yeah,
they're close.
They're very close to each other, which I think that is interesting. And then Pret is operating in 17 regions at the moment, where A&W is doing the same amount of money in one.
Yeah, and Pret, like I said, they have these restaurants in other locations, but it's just like it's nothing compared to the UK. The UK is where they're big, and they do have kind of various arrangements around the world where they're trying to export the brand kind of around the world, and this master franchise agreement like they have with A&W. So you'll see kind of Pret expand sort of around the world, but it's hard to say how big the Pret's going to be in Canada. I mean, it might just not, it doesn't catch on, and then it just doesn't catch on. Like it's maybe all it gets is just inside of A&W restaurants, and that's it.
Yeah, because like isn't not to keep bringing up like McDonald's and whatnot, but it's like it's hard to not compare the two. McDonald's is doing a partnership with like what, Dunkin' right now?
I think Krispy Kreme in the US.
Kreme? Okay, where they're like cross selling. It's an interesting model because like I almost feel like it takes maybe not, like does it take away from A&W's brand to be like, oh, when you walk in now there's a Pret sign, and now there's like, oh, here's some Pret coffee, like we don't make that coffee, that's Pret's coffee. Like it's an interesting approach to the business.
I think the plan is to replace A&W coffee with Pret coffee, but put it in a Pret cup. It's what they've done in their kind of test stores. I know there's one about 20 minutes down the road from me that we just sort of stumbled upon one day. My wife wanted coffee and went in, and it's like, hey, here's my A&W coffee in a Pret cup, and she thought it was pretty good coffee, but I didn't think it was anything special or anything. But Pret doesn't sell the same kind of food as what A&W does, with the exception of breakfast sandwiches. They both do breakfast sandwiches. So I think that, you can get some differentiation there, but at the end of the day, it's like you both sell food. And if you're like, you're a burger restaurant, and when you start selling mac and cheese and you start selling like kind of these specialty sandwiches and things like that, it is a little bit different in terms of kind of the brand fit. And there's certainly a possibility that they kind of, it'll clash a little bit.
Yeah, I'd hate to see them dilute their own brand, because then, especially like if they're keeping the whole branding and everything, you're at like almost the behest of like they can do something. Pret CEO text leak, you know what I mean? And then it's like, oh, well, now we're stuck in this. Like that wasn't us, I swear. Which I kind of like. I think one of the biggest negatives for A&W is when I talk about their stock on Twitter, I get people being like, "Oh, their burgers suck because they're from America." So I like they already have this problem with their brand being like
Mm.
diluted, and it's like, are you? They're gonna cut away even more of their brand to give it to. I don't like. I don't know. I don't know historically if these kind of partnerships work or not, and that's why I talk about the kind of Krispy Kreme and McDonald's. Like, obviously, if they're doing it too, they think it's a good idea.
I remember there was a guy on Twitter who, on FinTwit, who was a fairly big kind of account, and he was talking about A&W back when it came out with the Beyond Meat burger, and it was basically he was bearish on Beyond Meat and he was shorting Beyond Meat, which in hindsight was a good move. But I remember him kind of bashing A&W and W and being like, "Look, that's like third-rate Canadian fast food chain has like Beyond Meat burgers. Like, who cares?" And a few of us actually piped up, and it's like, look, like bash Beyond Meat all you want, but A&W is not a third-rate like fast food place. Like it's extremely successful in Canada. But it was the same thing where it's like he just assumed that A&W United States and A&W Canada was the same thing.
Yeah.
And he immediately discounted it as an investment possibility because he was a US based investor who didn't know that A&W Canada was different. So it's a valid point for sure what you bring up.
So, which is it's funny that you kind of alluded to like if they could just buy the trademark back or something like that. I don't think that would ever happen. I mean, like maybe we'll see how this goes in the next decade, but like I don't think they're in any position to do something like that. But it'd be interesting if they could just like, you know what, we're overhauling every store, we're making it the same. Would definitely be interesting because like it or not, whatever the American investor sentiment is in the stock market is for the most part
Yeah.
what is it's going to affect it pretty heavily.
Yeah.
Yeah. So one piece of trivia: first franchisee of A&W in Canada is in my home city of Winnipeg in 1956. So that's fun.
Oh, is that location that
I
was
I would
set
be
doing all the business?
I would be very curious to know if that is the location because if it is, that makes a lot of sense. That that's like the original Canadian location. Does not say specifically, but I that would be interesting. But a
I think too.
little bit more Winnipeg shout outs. I try to do as many as possible.
I was just going to say that too. Part of the moat of a company like A&W that's been around for a while is fast food. Ultimately comes down to real estate. And when you're A&W and you've been in business for like a long time in Canada, when did you say the first franchisee in Canada was? 1950s, I think.
56,
60s.
68
Yeah.
years ago.
So when you've been in business that long and you've kind of built up this network of restaurants, the locations are good, and as cities sort of build around those
Yeah.
locations, you've got kind of the best spots. And I'm thinking of I live close to West Edmonton Mall, and A&W is prominently located in West Edmonton Mall. Um, like it got good real estate, and that's important. It may be less important than 5 years ago with skip the dishes and stuff, but it's still important, and that's an advantage.
Yeah, because at least in my city, like, sure, they have a lot of gas station locations and mall locations, but they have a lot of standalone, like, only thing in the parking lot, like, major road. Yeah, you're right there. Um, do they? I assume they own the buildings and the land.
Um, Generally, the franchisee might,
Franchisee, yeah.
but for the most part, I think it's a more capital light business model.
Okay.
Someone else owns the buildings, and they just rent them out. I know there's some REITs out there who definitely own sort of
A
these
bunch of them.
kind of individual, yeah, these locations, and then typically what happens is the parent company will guarantee some of the leases, but that's only in the case that the franchisee doesn't pay. So you might see that on the balance sheet when the kind of when the operating company discloses their financials.
Okay, yeah, those would be interesting to dive into, or watch a YouTuber or read your sum up of it because I won't dive into it. But it'll be interesting to see stuff like that. Because, like, correct me if I'm wrong, but the movie The Founder would lead me to believe that, like, McDonald's owns the land under the restaurants and then leases them to the franchisees.
That's exactly right. McDonald's, and that was their genius
Yeah,
move back in the day,
the
was
whole
that
line
they,
that's like you're not a burger company, you're a real estate company.
yeah.
Yeah.
And it's been a while since I saw The Founder, so I might get this wrong, but there was basically McDonald's first CFO came in, and I can't remember the guy. It's like Harry Sonnenbaum or something. I think that that's wrong, but anyway, he comes in and he's just like, Ray, this isn't working, and he was the one who kind of came up with this real estate model because it let the banks kind of it was a lot easier to the banks to lend against property and to lend against land and lending against a restaurant. And then they just kind of grew it from there. And that's a big part of McDonald's business now, of course.
Yeah, which is interesting. As far as A&W goes, because like I think I want to bring this to a close. I don't know how much time you have, but we don't want to bore people. Kind of bring this to a close. I want to come to the conclusion whether I think this is a investment that people should make now going forward with the change of setup. So most franchises operate like food franchises where the franchisee is purchasing food from the franchisor. Is that
There's
how this functions?
essentially,
Yeah.
yeah.
Okay.
There's a bit of a kickback in terms of volume and things like that that the franchisee pays the franchisor, but it's tough because if the parent company is too aggressive in this, then the franchisees get mad and there's a bit of a rebellion, and that's bad. Ultimately, you got to keep your franchisees happy. So there's maybe a little bit of that, but for the most part, A&W is making their money on the the royalties and things like that.
Yeah, there's a company, I won't get too into detail, but that I'm familiar with, a relatively small private company that had a franchise model, and they were selling the materials to the franchisees at such a markup that it would have been like cheaper for the franchisee to go to Walmart and buy the stuff because they
Mhm.
wanted to squeeze out more money for the corporation. And then that became a huge problem where they're like, we're just gonna, why would I buy, like, yeah, and it became a whole issue. So that definitely don't want to get greedy as the parent company, because
No,
yeah, at the end of the day, if people aren't opening franchises, or if your current franchises say this isn't worth the amount of effort I'm putting in, then your model's kaput anyway.
the thing A&W realize and what good franchisors realize is that your easiest sort of way to expand is to engage current franchisees and say, listen, do you want to open up another one? Do you want to open
Mm.
up another one after that? And keep them engaged and keep them sort of so they like that they're making money, everyone's making money. And then it's a lot easier to do that versus trying to attract new people who don't have any restaurant experience.
So under the old model, you would own a franchise. Like, say I buy a A&W franchise, I pay franchise fees.
Mhm.
I pay market whatever the marketing fee is. That's usually pretty standard. I pay all these fees. That goes to the operating company, who then gives 3% of it to the royalty company.
Exactly. Yeah.
Okay. And now we just cut that middleman, and now it's just you can own the company that's getting paid the actual all the fees.
Exactly. You get everything. You don't just get the royalty on sales.
Yeah. Okay. Um, yeah, I guess, like, is there, because like my first gut reaction goes, the royalty model is a interesting, smart, good model because the company you own doesn't have a lot of exposure, risk exposure. Would you agree with that?
Yeah, it's all trade-offs at the end of the day, but when your income stream is kind of connected to the top line, then the expenses don't matter as much, and that kind of creates more certainty in the income stream. But the trade off, of course, is that when they use their operating leverage to grow the bottom line faster than the top line, the royalty holders don't get any of that. All they get is the top line. So it's depending on how you look at it, it's kind of pros and cons.
Is there? Do you think there's a time and a place for both models?
I think that it's yield-oriented investors would love royalty models because it's just like you're not screwing around with kind of the any struggles operationally or anything. It's just a very simple kind of model. But I don't think we'll see any additional royalty kind of companies come to the market, at least in terms of fast food or anything like that. You might see them in other sectors like gold. Of course, Franco-Nevada is a gold royalty company. Um, so fast food, I don't think you see it. I think investors want to own the whole operation because they get that operating leverage. But in other sectors, in terms of like another gold or oil or those Labrador iron ore, which owns a royalty on the on an iron ore mine in Labrador. These are all kind of interesting royalty models because they're for volatile commodities. You don't know what the price of gold is going to be next week. Got a pretty good idea what the price of a hamburger is going to be next week.
Yeah, yeah, that's fair. So do you think A&W once again is ahead of the trend with switching from a royalty model?
I think that they're not. They're just catching up to everyone else. It was a problem to have this royalty model, and higher interest rates exposed that problem even more than what it was before. And they're basically correcting a prior mistake in terms of kind of creating this model. It's just like everyone else, and now they can come to the market and they can say, "Hey, we're just like everyone else. Value us like everyone else," rather than valuing us based on interest rates.
So they were like how they're going to be before, and then they switched to the royalty, and now they're switching back.
Well, like, again, the royalty was this way to become publicly traded while satisfying that thirst for investor yield.
So they were private
Um,
100% until then.
exactly, yeah.
Okay.
They basically wanted to raise money and use it for expansion, and just like any company does when they go private or when they sell shares, when they go public or when they sell shares, and they just kind of did it in a weird way because that was the appetite of the market back then.
Was owned by Unilever until they went public.
I've heard that, and that's such a weird thing for Unilever to.
I guess like let's start with what are you okay, let's start with what is happening to our shares of AW.UN that we own.
So they are being acquired for $37 each by A&W, the parent company, A&W Food Services. You have two options. You can either take the cash at $37 a share, or you could take one share in the new company, which will be exchanged on a one-for-one basis. The issue with taking cash is that there's not enough cash put towards the offer to pay everyone in cash. So some investors will be forced to take either a prorated amount in shares, or if they just elect to keep their shares, then of course they would keep their shares. If everyone opted for cash, there's not enough cash out there. There's not enough cash connected to the deal to pay everyone cash. So keep that in mind if you're someone who's looking at buying the shares for, I think they're a little bit under 35 right now, and selling them for 37.
You
That
might
might
not be
get
able to.
you, it'll give you some, it'll likely give you some cash and some shares. So just keep that in mind. For those of us who are going to keep our shares, like me, I plan to just keep my
That
shares.
was going to be my
This is
next
not a big
question.
deal.
Yeah, that was going to be my next question is given the option, what are you doing?
Yeah. So what I like about this deal is the I get the same exposure to A&W, but I get something that's growing faster than what the royalty company was growing. And ultimately, I think what that does is it takes A&W shares and it takes away that interest rate narrative that I talked about earlier, and it creates this fast food franchise. It's exactly like the rest of the fast food franchises out there, and it becomes less about the dividend. And so when that happens, then hopefully we get this kind of boost in valuation, which will boost the share price. Now, obviously, there's variables in terms of A&W has to perform as a company in order for that to happen, and the Canadian economy is a little bit sluggish right now. But over the long term, I believe that this move will result in greater earnings growth for a number of reasons.
That's basically my thesis. Or my thesis would be basically I still like A&W. I still like it as a company. I still like their burgers. I was most likely going to hold the shares in the new company. What do you think about adding more shares? Because if the deal's for $37, then the price has to go up to $37, right?
Sorry, I'm just gonna
Yeah, you're getting a little bit. That's
get a little
fine.
dark there.
Yeah, no good.
Okay, so would I buy at 35? Well, my problem is I'm anchored at this lower price, and so I actually added to my A&W position in the last sort of 6 weeks, um, and I paid under $30 a share when I did add. So I'm anchored to that price. So I don't think I personally would buy any more A&W right here. I think that there's going to be some uncertainty surrounding the deal, and what I'm worried about in the short term is investors who get in who try to play the arbitrage or who kind of end up with these A&W shares that they don't really want anymore. Like they want their cash and they just want to get out because it hasn't really performed that well over the last 2 years.
Yeah.
I think that they will, once this kind of new company starts trading, there's a possibility that they will kind of say, hey, I don't want these shares anymore, get rid of them. And that kind of causes a bit of a sell off at the beginning. And there could be some bargains available at that point. The other thing is, so you got your phone up there. I was going to say the other thing is there's a little bit of kind of financial information that's been released right now. I've sort of pieced it together that I'm comfortable with it, but you're going to see more kind of stuff come out as we get closer to the kind of this new company trading. And there's the possibility that investors will look at it, they might not like what they see, and then they'll sell their shares at that point too. So I'm cautious over the sort of this near term, but long term, I'm still quite bullish.
Because I guess it's unlikely but not impossible that we get the disclosure from the new company. It's like, oh, we're actually burning money. We make no profit. We're out of business in 5 years.
I don't think it'll be that bad, but I think it'll
But
be this like, oh, I thought that, maybe margins would be higher. They might like compare it to like a McDonald's or whatever and might say, yeah, it's worse than McDonald's or
yeah.
or whatever. Again, there's some that they've kind of disclosed, and from what I've looked at it, it's like this is like the this is very comparable to a lot of their peers. It's a like the it's just there's not a lot of expenses. It's very asset light. The growth is driven by franchisees, et cetera, et cetera. This is all good, but ultimately there's the risk that it's this unknown, and
Yeah.
I don't know how investors will react, and I worry that they'll react negatively.
Are there large institutional investors that we know about that own much of this company?
I don't think so at this point because it was small. The market cap was,
Yeah, it's
I think the
what,
market cap of
600
the
million right now?
yeah, so it's small, and A&W Food Services is actually the largest shareholder of A&W Royalties. So the float is even smaller
Yeah.
than kind of the market cap would indicate. So I don't think there's a lot of big shareholders out there. I think it's just kind of there's a lot of retail and maybe small funds that hold it.
Yeah. Okay. Yeah, I think I'm bullish in the long term. Most of my positions in my stock portfolio are kind of like lifetime holds, and if not lifetime holds, then like sell when I'll use retirement age in quotations. I don't think I'm ever going to retire, but like when I'm, if I ever have to sell shares. And that's why I'm always on the dividend side of the dividend hold debate, because I don't like selling my shares. Like, I don't like selling my assets to make money. I think if you have to sell off your assets, like coming as a small business owner who has grown, a company from zero to $400,000 a year in sales, and then purchased another company that's doing, a quarter million in sales. I don't want to have to be like, oh, guess, we're having a down quarter, got to sell a wine tank to make money. Like, I like that mentality. I'm coming at my dividend investing with the same mentality. It's like, well, I'm not going to sell my assets to make money. That doesn't make any sense. So that's where kind of like I am with that too. Is like I like getting paid the dividend because it's cash that I can get paid and buy groceries on and beer and bubbly, but I don't have to sell my underlying asset, right? Like it's generating income.
The 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 piece of feedback you always get from these, like what they call them anti-dividend guys, like, well, you can always just sell shares and create your own dividend.
Yeah.
Well, what happens is the average investor is quite bad at selling. And, I say this, I went back, this was a few months ago now, and I went back to my brokerage history and I looked at the last kind of like 10 years of transactions. And what I found is that there were times where it's like I sold what ended up being this like massive long term winner for like some reason that I don't even remember. And my favorite story is Intertape Polymer. So this is a company that makes like plastics, various plastics. And one of their big products was wrap for houses. So you build this house, you wrap it with this thing, creates like a vapor barrier or whatever, and then you put the siding on or the stucco or whatever. And of course, this market collapsed in 2007. And I bought the stock. I didn't know what I was doing in 2007, but I bought the stock. It survived the financial crisis. And then in, I think, 2011, I bought for like $2 and change. 2011, I sold some for $7 and change. And then in, I think, like a year later or 2 years later, I sold the rest for $11 and change. And so at the time, I'm thinking to myself, like, I'm a genius. I made like, like my average sale was 9. I paid a little over 2. Like that's a really nice return. It only took like 5 years. And then I moved on with my life and everything was fine until about 2021 or 2022. Intertape Polymer got taken out for $40.50 a share. And it paid dividends starting in about 2013 all the way to 2022. So I missed out on a life changing kind of amount of money because I sold way too early. And it's that point when I realized, like, I'm not very good at selling. And I don't think the average investor is very good at selling either. And because of that, I need an investment strategy that makes sure that I minimize my sell decisions. And that for me is a big reason why I like dividend investing so much.
Yeah. And I think A&W has a dividend that is sustainable. I mean, I guess we'll find out when the when the new kind of company like this is, but operationally, I think they're not going anywhere anytime soon. I don't think this is going to make a major change as far as like the actual business operations, the day to day goes. And if I thought it was had strong fundamentals as a business, this in my mind doesn't change much of the investment for me. How the
I
structure is, structured.
That's it. I agree. I think ultimately growth is going to be higher from this new structure, and higher growth should translate into higher dividend growth. And A&W has consistently raised its dividend, not every year. And of course, we had the 2020 dividend cut that we talked about, but for the most part, the dividend has consistently kind of marched higher. And I think with this new structure, that the dividend growth will be a little bit better going forward than what it has been before. That's kind of this like 4 to 5% dividend growth over the last 20 years on average. It'll be sort of in that 5, 6, 7% is my guess, just based on sort of the operating leverage that I think the company can extract, which should lead to the bottom line increasing a little faster than what it did before.
So, would you tell people to buy before this deal is all done?
I I would wait. I would wait until there's a little bit more information and a little bit more kind of certainty to what's going to happen in terms of kind of what the deal is going to look like. I've got a pretty good idea. There's information out there, but it's, when these deals happen, the companies have to be a little bit vague, and they have to kind of like, hey, look, like this is sort of what it looks like, but we can't make a lot of promises. And then as you get closer, kind of more information comes out and more analysis comes out and so on. What I'm worried about is like I was saying earlier, if sort of some negative news comes out and the stock kind of goes down, then there's this opportunity to sort of buy more at a cheaper price. And I really don't know what's going to happen in the near term. Again, long term, I'm bullish, but in the near term, there could be a better buying opportunity in the next few months.
Do we have a timeline on this?
Q4, I think they said that the deal will go through. Other than that, we don't know. It'll have to pass a shareholder vote, but those are usually just kind of a rubber stamp.
Especially if the operational company already owns like 40% of the company, right?
That's it. It's I don't envision that being a problem. They have to apply to kind of get food services to list on the TSX versus the royalty company, but again, that's not a tough thing. It just will take a little bit of time. Yeah. I'd be surprised if it wasn't done by the end of the year.
Okay. Well, I think that's basically everything I wanted to talk about. This is just a company that I like and I like investing in. Mm-hmm. I do this A&W challenge. If people are not aware listening, that every time I eat there, I buy a share. And I haven't bought a lot of shares because I'm really trying to cut down on the A&W, but every so often I'm drunk and I'm like, oh, it hit right now. But yeah, I appreciate you coming on to talk about this, because you are one of the most knowledgeable people I personally talk to that about this company specifically. I know that every time you post about it, I'm always in your replies, being like,
you are, yeah.
You are releasing a more detailed newsletter about this whole thing as well. So if you wanted to tell people where to find that.
So I write a newsletter focused on Canadian dividend stocks. You can find it at canadiandividendinvesting.beehive.com, or you just go on my Twitter, which is at CDI Newsletter, and click on the link, and you'll find it. It is exclusively for premium subscribers. So don't go showing up and get upset because it's exclusively for them, but it's already done. Actually, it was supposed to be released on Friday. I decided to release it a little early because you weren't the only one who was curious about what I thought. There's actually a bunch of subscribers. I was like, hey, like we need to know your thoughts, and I said, okay, I'll put them together and kind of release that. So it'll be out on Thursday.
Okay, cool. And for reference, we were recording this on a Tuesday, so 2 days before it comes out. We have no idea when Willows will edit this and put it out. That's always up for debate, but it will be on the internet at some point. If you want to follow Nelson on Twitter, I will put it in the description, or X. It's funny that like you can like see people, you listen to a podcast from a long time ago and they're calling it Twitter, and you're like, oh, this must have been recorded pre 2024, but then it's like it's still 2024 and we're still calling it Twitter. So it's like I think it's funny.
I refuse to call it X. It's Twitter to me.
Yeah, that's fair.
Small town small town that I grew up in, they had an IGA, and the IGA changed away from IGA in like I don't know, like 2013 or something,
Yeah,
and like half the town still calls it IGA. So
yeah.
it's just a
When I was
thing.
when I was 18, there was this um, convenience store on the corner from my trap house, and my roommates all called it Cops, so we started calling it Cops, and it was called Cops like in the 1980s, and that's just what
Yeah.
my roommate's mom called it. So then he called it, so we called it. And we're like, oh, go to Cops, and then people that didn't really know us well were like, what are you talking about? Like, and I'm like, I don't know actually. Um, but yeah, if you're watching this on my channel, I think that's where I'm putting it, subscribe, right? I don't know, follow me.
Mhm.
Drunk Dividends for any of my financial stuff. Vote Willows on everything else for my personal stuff. I appreciate you coming on. And I hope that we gave some succinct value. Everything Nelson says is not financial advice, and everything I say is financial advice.
Then we'd better listen to you and not me.
Exactly. I'll drink to that. I think like I don't know. I feel like if people give it financial advice and then say this isn't financial advice, they're not covered, right? Like that's why I like doing that, because I'm like, you're dumb. And then if anyone's gonna like,
Exactly.
I will say Exhibit A, Your Honor, drunk dividends.
You know, the people that really, really worry about that in this space, and I just tell people what I do with my money, and I figure that covers me. And if not, hey, whoever does the action, they clicked on the stock, they bought it. They didn't have to listen to me. So I'm going to say what I say is 100% financial advice too. Sure, why not?
I might sue you because I'm down 25% on Mexican Dollarama.
I never bought Mexican Dollarama.
What?
I stuck with the good Dollarama.
That's fair. Yeah, no. The only reason I learned about it from your tweet, and the only reason I bought it was because Peso Rama instead of Dollarama. I
Great name,
I
right?
bought like $20, and I'm down like 25% since then. But a great name.
By the way, Dollarama is expanded into Mexico. I think 2026 they said that they'll start opening stores there.
Maybe they'll buy him
So
out. Buyout imminent.
dump
You heard it
the
here first.
dump the peso Rama, go with the real Rama, and
I
then
think
don't sue me or
I'm
or do whatever. It'll be fun.
I'm more bullish on Dollar Tree, I think, than Dollarama, but that's a video for another time.
That is a video for another time.
Okay. Thank you for coming on. And thank you for listening, everybody.